Welcome to Dezerv's monthly market update. In today's episode, Vaibhav Porwal, our co-founder, will take us through three important aspects. The first, what's driven the markets in the last 1 month. Second, what these drivers mean for investors. And third, how should investors invest in the coming few months? Hi Vaibhav.
Hi Namita.
So Vaibhav, what do you think has driven the markets in the last 1 month?
September was a great month. It can be characterized as a month of new highs. We saw Indian equity markets hitting a new high. Sensex crossed 85,000 levels for the first time. We saw gold hitting a new high. Gold in dollar terms went up to almost $2,700. We saw interest rates going down, and as a result of that, bond prices hitting a new high. And IPO markets continued to hit new frenzy. 12 IPOs and 9,000 crores of mobilization only in the month of September. And honestly, this frenzy was not limited to financial markets. It extended to other parts of our society also. Consumerism in India hit a new high with Coldplay event. So we can easily say that September was a month of new high.
Not to forget even the F&O market, where SEBI in fact released a report where there is so much of activity in the F&O market and people are still making big losses, but there is a frenzy.
That's a great paradox for me. People continue to make losses and continue to trade. So I'm not able to understand why people behave like that.
So what do you think is driving these markets and how should investors look at it?
See, some of these factors are anticipated factors. We have been talking about some of these factors, and some of these factors are new factors. So for example, US Fed rate cut was impending. We have been talking about a rate cut initiation by US Fed, but they delayed it. But after a delay, they went ahead and cut with a much larger number, 50 basis compared to an anticipated number of 25 basis. Impact of that will be meaningful on the market. Typically, when central banks are cutting rates, it indicates that economy is slowing down. So we have to be mindful that when we are investing in growth assets, we have to take into consideration that economy is going to slow down. Now, the unanticipated part was triggered by Chinese regulators. Chinese economy has been struggling for last 3-4 years. Finally, they intervened with a great amount of intensity. First, they infused a lot of liquidity in the system. Almost $143 billion worth of liquidity came into the system, which is a large number. They gave a lot of flexibility to the home buyers by saying that down payment requirement will be only 15%. They reduced interest rates and also allowed companies to borrow money to initiate buyback. So companies can actually borrow money now and buy back their shares, which I think will take up their stock prices higher. So some of these factors created this up move in the market. In India's context, Indian domestic investors continue to invest with a great amount of intensity. The money continues to come in equity market. People are moving money away from other asset classes, and equity is becoming a big beneficiary of that. So these are some of the factors which are driving the Indian equity market or global equity markets.
So typically when an interest rate cut happens, right, gold and real estate tend to do well. So what is your take on that?
No, it's a great time to look at other asset classes also. Gold and real estate, as you rightly said, are big beneficiaries of interest rate cut. Gold prices go up because interest rate cut means liquidity will be higher in the system, and reacting to that, gold prices go up. Real estate also benefit because home buyers can potentially borrow money at much lower cost and invest that money in real estate. So both these asset classes benefit because of that. Investors should maintain a good balance of equity, fixed income, gold and real estate in their portfolio. In last 3-4 years, equity markets have delivered tremendous returns. As a result of that, portfolios of investors have drifted away towards equity. Maybe it's time to relook at the portfolio, rebalance the portfolio and manage the risk much more efficiently. Our belief is that an ideal portfolio should have the right mix of all asset classes, which are growth asset classes and income asset classes, and some allocation to hard assets. All three asset classes or all three segments of portfolio should deliver returns for investors over a long period of time to give stability.
So talking about liquidity, we're already seeing a lot of liquidity in the markets, and with an interest rate cut, do you think liquidity will drive the markets even more in the future?
No, important point, but let's not look at this data point in isolation. Let's look at markets in two parts, top 100 companies and companies beyond that. top 100 companies represent 75% of Indian market cap, which is at $5 trillion today. So $3.75 trillion of market cap is represented by top 100 companies. They have not seen too much liquidity coming their way. Most of the liquidity which is coming from domestic sources is focusing on companies beyond top 100, whether it is in mutual funds when investors are allocating money to mid and small cap category, or by investing directly in the shares of the companies. This liquidity is getting invested in companies beyond top 100. And there are pockets in that segment of the market where valuations are excessive and are getting into a territory of high risk. Investors will be well served if they can reallocate their money from that segment of the market and move towards top 100 companies. See, liquidity is there. Liquidity's distribution is more important, where that liquidity is going. If liquidity starts moving towards top 100 companies where valuations are reasonable, then there is no concern. But if liquidity continues to flow in companies beyond top 100, then we are getting into a territory of bubble.
So we believe that the valuations in the small and mid cap segment are slightly high and we should focus on large caps right now.
Absolutely. Our comfort is much more on large cap, and which is something that we have been emphasizing on over last 4 to 6 months.
And what about fixed income?
Fixed income is interesting. Given that interest rate cycle is reversing, we will see a lot of action in fixed income also. Investors will look to invest money in high maturity bonds where they can benefit because of capital gain in these bonds. So whenever interest rates go down, prices of the bonds go up and investors will look to benefit from that. Along with that, investors should also look at locking in money for a longer duration at current rates, because our view is that interest rate cycle is reversing and going ahead, investors will be able to generate much lower returns in fixed income compared to what they will if they lock in money today.
And Vaibhav, to conclude, how did we position our portfolios for investors in the last few months?
So in equity, we have been overweight on large caps. Besides focusing on large cap, we are also focusing on funds where valuations are much lower compared to the overall market, and are also looking at underlying portfolios and their valuations and earning growth potential. So these are some of the things that we are focusing on. Within fixed income, we have created a portfolio where our objective is to generate high income accrual, but along with that we add some duration by way of investing in REITs and InvITs. So the positioning of the portfolio in equity is large cap, focusing on valuations, focusing on earning growth potential of the company. In fixed income, accrual along with some allocation to duration. So that's been our positioning, and we continue to maintain our stance on both of these asset classes. On top of that, we are adding allocation to gold in our portfolio. So these are the 3 areas of focus for us in our portfolios.
And real estate as well.
Real estate is there. In our fixed income, we have added REITs and InvITs, which are nothing but a proxy of real estate.
So sticking to the fundamentals, in equity, a large cap bias, and in fixed income, a duration play.
Absolutely.
Thank you, Vaibhav. That's all for today. See you in the next monthly market update.